Hey everybody, Marty Missouri here. This is an economic wrap and a stock market snapshot for the week ending June 24th. Going to be a quick one for you. Circumstances, the end of this week did not allow me to be in the office Thursday and Friday, therefore you didn't get those morning notes. And looking like be pretty much back in the saddle come Monday morning. I was able to score our index today. Wanted to give you just a quick synopsis of what I see there, and I'll do a quick stock market snapshot. Last one we did was Wednesday, and just some overall commentary, but folks, I'm going to need to keep it relatively quick but hopefully meaningful for you. So our economic index is getting pretty close to recessionary conditions. 4.35 was the score, down about 6 points from the previous week. Lots of calls now, recession calls. We're either real close or we're already there, or 80% odds that we're going to get there in 2022 all across the board. We're not in that camp yet. We're very happy to be. We were definitely in that camp back here, but we're not here just yet because our overall assessment says that although barely, odds still favor ongoing expansion over recession. As I kind of suggested, I think in that last video, there is kind of a Goldilocks scenario or narrative that we're kind of developing that doesn't have real high probabilities, but it has to do more with global conditions and how economies like China's could have a positive impact on the global economy over the next few weeks and months. And what I'm going to show you in terms of the inputs to our index, 33% are still positive, which is 15 of our data points. 28% are negative, 39% score neutral. And what I wanted to show you is 7 or 8 of the positive data points, just to show you, important statistics. And you'll agree with regard to their importance when you see what they are. They really aren't giving you recessionary signals. I'll show you those. I do want to show you the copper chart and give you a quick comment or two on that, and then we'll jump over to the equity market. Consumer spending, at least the last reading, continues to hold up 0.9% month over month. Consumers aren't necessarily ramping up their volume in terms of goods bought, so to speak, or services bought. It's just that they're costing more, so that continues to go up. So that would be the dollar value of consumer spending. But again, this is what recessions look like. And as you can see, we're not screaming recession right here, at least not yet. Job openings, 11.4, just off of all-time highs. If you're just looking at the employment data, it's hard to make a recession call, right? So that's what job openings look like heading into or during recessions, right? Quits rate, to the extent that folks are just quitting their jobs. Folks don't quit their jobs when they're not confident that there's a job in the waiting. As you can see, this is what recession or going into recessions look like. And this is what we have right here with a historically high number. So again, looking at job openings, looking at quits rate, you're not looking at recessionary conditions when you just look at those. Staying on the employment thread, the NFIB Small Business Survey last month hiring plans component just ramped up noticeably. So small business, what do they employ? 60% of the U.S. workforce are saying they are going to be hiring people going forward. You tend not to do that during recessionary conditions. So again, not a recession indicator there. Industrial production, 5.8%, year over year, that's not bad. 0.2 in terms of the month-on-month rate of change. Capacity utilization, the degree to which factories are running at capacity, 79%. Again, that's what recessionary conditions look like, right? Virtually without exception. And so could roll over quickly, right? But it's just not an indicator that would say recession looms, not yet. CapEx, capital expenditure, this is business expansion, non-residential investment, right? Capital goods new orders, capital goods shipments. This is what recessionary conditions look like during recession, going into recession. And this is the look right here. Again, not the least bit screaming recession right here, nor is truck tonnage just yet. That's what it looks like when it's bad. This is what it looks like when it's good. Staying with transportation, the Cass Freight Shipments Index, nice move there, very volatile. but this would be an encouraging look here, at least as of last month's report. And then lastly, though, I did throw in one negative, and that's the copper look. Now, folks, recall right back in about here, you're looking at copper coming off of this support, and there was talk of China reopening and so forth. So I said there could be more upside, but I also said this could easily turn into a bear flag pattern, and we could easily see that play out and come down this low, and we would not even be flinching with our long-term bullish outlook for copper for all the reasons I've written about and talked about, and I will again for sure. Some people are calling for a further drop to 8,000 a ton as support. Could definitely be. While we are bullish long-term, we do see the kinds of stresses in the economy that could definitely have traders pushing the price of things like copper lower. But I would view this, for anybody who doesn't have that exposure, is a place to at least begin scaling in if they're long-term patient investors. Okay, so that's it for the economic data points. Let's take a look at the technicals for the S&P 500. So folks, recall back in here when we were drawing these this downward wedge, and I think I said the last time, this is very, very positive looking divergences, and that while anything's possible and there's reasons to think that maybe this market won't bounce, the technicals were looking like it very well could. And it was about a week ago when I gave you that video, Bear Market Rally Prospects, which there's kind of a whole perfect storm of things that were kind of coming together. Some of them counterintuitive, contrarian signals that said, we're still bearish longer term yet, but boy, we could sure see what could be a special bear market rally, and it sure got special last week, no doubt about it. And this still is a pretty positive look. I do think people this last week, among quite a bit of short covering, no doubt. I talked last time about all the short interest that was out there, but also month-end rebalancing. Right, it's been a really miserable month up to last week for stocks. Automatic rebalancing that happens in what, let's just say, is very not small volume across these target funds, where they target the allocation and they rebalance monthly, quarterly, or what have you. This is the end of June, and this is, I think a lot of people are talking about that and have expectations that there's going to be a bunch of that. Now, the more the market begins to anticipate that, the more it happens earlier as people try to front run it. But that's another thing I think that is in people's heads that say, maybe there's some more oomph to the end of June. It'll be real interesting to see what the charts are pointing to as we get into July. And I think in the interest of time, we'll just look at the daily, and I'll skip the weekly and monthly. They do not even remotely suggest that we should begin getting super bullish here or begin thinking that the bear market has come to an end. The daily, however, it suggested, as I showed you in here, as we extended that falling wedge pattern, showed you the beginning of the bullish divergence, almost really official there, with a buy signal if the white gets above the red, which looks like it probably will. We had a gap here. Gaps tend to get filled, and you notice right there, it just filled it on Friday. Sometimes that's resistance. You could see traders coming in and selling the market right against that resistance. Still have another one up here, though, so we'll see. Wouldn't surprise me too much if this next week, for some of these factors I've talked about, we get that one done as well. Before you know it, we're starting to threaten that upside target that we had for a bear market rally, which was 4,300. This one looks pretty compelling right here. If we do get more of a ramp up, be looking for real resistance there and some serious resistance at, say, 4,180. One more I want to show you, and that's that weekly oversold condition on the NASDAQ. Remember when this happened, first time in a while, and this is below 30 on the weekly RSI, and I showed you over 30 years, every single time we got there, we got a pop, even in the worst of bear markets. And prior to this last one in May, the worst rally was 14%. So this one sets a new record at 12. So not bad. Within 2 weeks of the bottom, this particular index up 12%. Well, we hit that oversold again. It was below 30 right here at 29 something. And here we are, the following week, up 10%. So we'll see. If it stops right here and rolls back over, still it's a 10% move. That is a tradable indicator if I ever saw one. So short-term traders would want to go long the NASDAQ virtually anytime you see it oversold right here. And I hate to be that simplistic, but this one has worked quite nicely for a nice pop. So folks, again, thank you for your patience. Sorry I missed you on Thursday and Friday. Those of you who read the every morning know, and I'm thinking and hoping that things will be back to normal by next week. You should receive this sometime over the weekend, and I hope you're enjoying the weekend, and I'll talk to you again soon. Thank you so much for watching and listening. Take care. Bye-bye.